This year, the IPTF have widened our focus to include ASU insurance, recognising that traditional income protection isn't for everyone. We've seen a huge interest in ASU content and we've decided to include it in IPAW this year. And I'm delighted to welcome Ian Sawyer, Commercial Director at Howden Life and Health, to have a chat about all things ASU. Hello, Ian.
Morning.
So let's start with the basics, Ian. What do we mean by ASU? What are the key things that you think we need to know?
Okay, so a very fundamental level, ASU, accident, sickness, and unemployment cover, which can be purchased together as accident, sickness, and unemployment, or independently, accident, sickness on its own, and unemployment on its own. I suppose it's key to understand that this is a general insurance product, which is annually or monthly renewable, effectively. Covers comes under the different set of regulation, but in essence, it's a simple insurance product which meets the needs of a great many people, more people than perhaps it's given credit for. The key difference between ASU and other income protection, first and most obviously, then it's the benefit period. The benefit period is 12 months. There are limitations in terms of the amounts that you can cover. And there's limitations in terms of certain occupational groups as well, but that's more aimed at the unemployment side of things.
Thank you, Ian. A useful start to those new to ASU. So, what does ASU typically cover in terms of earnings, claim duration, qualifying events, etc.?
Well, the biggest difference from traditional IP is the pre-existing conditions exclusion. So any ASU policy starts with a pre-ex conditions exclusion. Anything in the last 2 years will be excluded pretty much forever, to be quite frank, and a stress and back condition exclusion. Now, that's not a total exclusion. It's an exclusion from conditions which are met by GPs. If you're referred to a consultant at the more serious level, then a claim can be made. So that's that protects the insurer from abuse and from people purchasing it and just straight off claiming straight away, and it enables them to manage costs, which keeps the cost of ASU to an affordable level. The issue is because there is no medical underwriting questions, everybody can get this cover. So unlike long-term IP, people can get some protection against future events, but not against pre-existing conditions. In many ways, it works a little bit like a private medical insurance.
As I've already mentioned, Ian, we've seen a huge amount of interest in ASU since we started talking about it in February, but we've also realised that advisors don't really know much about the product. What are the biggest misconceptions that you've found about ASU amongst advisors and clients, and how do you think they could be addressed?
Well, I think we need to look at history for that one, Vicky. ASU does have a bit of a checkered history in the sense that it is tarnished by the PPI mis-selling scandal, unfairly tarnished because, of course, that was delivered by banks, building societies, credit companies, and associate product. What we're talking about is an independent product sold by advisors for meeting the needs of individual customers. So many people think that ASU is a bad product. It is not. It meets the needs of a great many. Claims are paid out all the time and satisfy many great needs. It's low cost. It's not complicated by medical underwriting. So it does the job for consumers, or a job for consumers. Also, advisors seem to historically feel it's complex. And that's because historically there used to be mortgage products and income products. And mortgage products were limited to the amount of the mortgage plus around 25%. Now, that doesn't meet the needs of many consumers. Your mortgage is usually about, I don't know, 25 33% of your overall expenditure, monthly expenditure, when you think of bills, food, entertainment, just living life. So that has a very limitation, but it is also considered a mortgage risk is considered a lower risk, and therefore insurers give it a cheaper price. Products have moved on now. So you have products where it caters for the mortgage, your bills, and your additional income expenditure. So it's much more flexible. So advisors don't have to get wrapped up, or do I sell a mortgage product because it's cheaper? Because if I sell an income protection product, it's more expensive. Now they can that's kind of melded together and satisfy both or all the client's needs.
Thanks, Ian. That's really clear. And I think on the subject of comparing products and understanding what they do and don't cover, I think because of some of the questions being asked by advisors, your firm, and particularly Andy Leonard from your firm, has helped us pull together a very simple ASU matrix, which we launched today. And you can access it www.iptf.co.uk in the advisor tools section and also in the ASU tools section. So worth having a look. I think that really will simplify it. And that's very much based on a write it yourself or refer it. So on that note, why do you think advisors should consider writing it for themselves?
Well, I think everybody feels more comfortable writing the business themselves and retaining the customer kind of relationship. Making recommendations to others is always considered a risk, and understandably so. But I think life moves on, doesn't it? The business has moved on. We've got to get more comfortable with signposting to experts who can cater for things. So the products that IPTF have put together in a small panel represent a different set of quality choices. I think one of the things to your earlier question is, fear factor from advisors is that these brands that you'll see are not familiar brands. It's not an Aviva, it's not a Bupa, it's not a Legal and General. These are very small companies producing these products. But it's important to note that they are underwritten by very large bona fide insurance companies like AmTrust, who are a really important and big player, and Lloyd syndicates as well, sit behind the product, and they are as heavily regulated as any other product that you will use. So first off, if you're an advisor and you want to retain that customer contact, then yes, get familiar with the product. I would research the products and choose your favored one, which gives you the most amount of flexibility. But inevitably, there will be situations where the product won't meet that particular client's needs, especially for higher value sums, because there are limits to how much each product will cover, usually around £2,500 a month. And then you have to get into a point of saying, right, okay, we need a combination of products to meet that client's needs. So that's when you might want to refer on to a specialist, and trust the fact that, when you're picking a specialist, look into their credentials. Are they IPTF members? Are they PDG members? Do they have the history, the understanding, the technology, those types of things, and recognise that there are specialists in different markets, as exactly the same as if you're referring to a mortgage broker or a IFA for investments and pensions.
Thanks, Ian. And we talked about consumers there a little bit. What kind of consumer is this product suitable for? Is it manual workers? Is it people who can't get traditional income protection because of health issues? Who's a typical customer? What do they look like?
Well, I think again, if you look back at history, this was really considered a blue collar worker. But we have clients who are oil executives, industry leaders, highly paid people in local government, all sorts of things. And I think that the difference is remember that the bigger risk for many people is unemployment. and there isn't an alternative to this. So we have a really, really broad range of customers who are satisfied by this product. There's no argument that long-term income protection is better from the AS, the accident sickness point of view. But of course, a great many people are either declined, completion rates in income protection are around 70%. I mean, 30% are either fading through the system, can't get GP records, being declined, being postponed. So this will provide an alternative, but it will give a 12-month benefit. Some people use it in tandem and have an AS for the first 12 months and then a 12-month deferment on long-term IP, especially if they also need unemployment cover. Unemployment cover on its own can also be purchased. So if you've got a client who is worried about their employment, long-term prospects, then they could have a long-term IP and an independent unemployment only plan. When we're talking about unemployment, please bear in mind that this is probably the most abused policy, maybe next to travel insurance, by consumers, where people tend to buy it when they know that their company is in trouble or their job is in trouble. And of course, any prior knowledge of restructures, redundancies within the client's business or employer will preclude them from making a claim.
Very good points, Ian. And yes, I think with all insurances that's the case, but specifically good to point out that there is abuse in this area, and we certainly want to make sure that that doesn't happen, and serve the underserved, but do it sensibly, and grow the market sustainably. And I guess finally, Ian, if you had one wish for the ASU market over the next 12 months, what would that be?
Oh gosh, I would love more bona fide insurers to take an interest, perhaps team up, offer an unemployment module to a long-term IP product. That would be really nice. Legal in general were used to be quite prevalent in this market, but exited and sold that part of the business. It would be great to see others join the fray, because there's demand out there.